Welcome to Daily Tax Savings. This is Tony Novak here to share a few points on saving taxes and staying out of tax trouble. Today's topic is, why is low salary a problem? And interesting topic. So let me first define what we're talking about. We're talking about business owners, specifically corporation owners. If we're self-employed, we own a business as a sole proprietorship or a partnership or an LLC that's taxed as either sole proprietor or partnership. This does not apply. This only applies to corporations. Second point is, we're specifically not talking about the most common problem that gets beaten to death in social media, and we've probably covered it a half a dozen times on this show. That is when there's an S corporation with big earnings, low salary, and big amounts paid in corporate dividend. That's an issue, that's a problem, but it's an entirely different problem. What I'm talking about is when the corporate profits perhaps are low, and the owner's salary is low year after year after year. And this episode, like many, is tied to a real life example. I have a phone conversation I had this morning with a contractor and his wife, and so I'll use that story to illustrate my point. So here we have a very capable and successful business owner, and I say that because the business has grown each year for almost a decade, well over $1 million in revenue, and yet the owner takes a salary of $500 a week. That is probably less than he would make if he took a job flipping burgers at McDonald's or something equivalent. You get the idea, a minimum type of job. So when we're young and we're passionate about our business and we're investing in our business, sure, we can take a low salary. But a decade later, if we're still taking a low salary, it raises some tax risk and some possible suspicion. So I would explain it this way. If you're working, busting your tail, building a business, and only taking a small salary, there is very likely another part of the picture we don't see, that we've not uncovered yet. And in this situation, we're talking about IRS specifically, but it doesn't matter whether it's IRS or your accountant or your banker or your brother-in-law. All of those are going to suspect that something else is going on that they don't see. And of course, this show, we're focused on minimizing tax risk. So let's talk about that. So if an IRS looks at a business like that, over $1 million earnings, the owner's only taking $25,000 salary, and they've been doing this for 10 years, and the business is barely profitable. Oh, and I mentioned in this example, the wife even said some weeks when business is slow, the owner doesn't even take a salary. They pay the employees, but the owner doesn't take a salary. Good, smart, logical business strategy, right? We all do that. We put our employees first, and we put ourselves last, and there are ups and downs in business, so that makes sense. But in this case, if it continues to go on year after year after year, one of a couple things is likely happening. One is, we mentioned about the S corporation, money flowing out not as salary. Again, that's not what we're focused on. Second is the possibility that there's a cash flow coming in and coming out that we don't even see off the books. All cash jobs don't go on the books and are paid directly into the owner's pockets. That is a risk in small business. It's a real risk. It happens often. So by taking a low salary, you increase that risk. You know, who would work 10 years and for $25,000 if there's not some other side benefit in the way of a cash flow. That's the logic. So we're raising that risk. Second is the possibility that certain types of businesses will only achieve a profit on the year they sell. The classic example is a farm. And I use my own case, a marina. A marina and a farm can lose money every single year, and the only profitable year will be the year that you sell the property. IRS is okay with that. We have to look at the situation and see, yes, we're willing to suffer, take some sacrifices over the years for a financial reward later on. Another possibility is that I mentioned the cash coming in that we don't see. Another possibility is sort of like the farm, but related to business assets. We would expect to see, if an owner's taking a low salary, that they're building up net worth in the business. It's worth it to take a low salary if your business is increasing in value each year. And obviously that's easy to see in the case of a farm or a marina. But what about other cases? This was a contractor. What we would expect to see, if the business isn't taking a profit and the owner isn't taking a salary, we would expect to see the business assets rising every year. In this case, they are borrowing money to build up assets. We would expect to see the equipment and the business property or real estate and whatever else is inventory to be increasing over time. And that's a good reason, good logical reason why salary might be low. But if we can't see any of those and none of them seems to apply, it's perfectly reasonable for the IRS or a state auditor or your banker or your accountant to say, hey, what's going on here? Hope that makes sense. I would love to hear your thoughts, comments, or feedback on the topic. Or if you want to speak with me one-on-one about any topic, that's easy also. Find me at taxproblems.cpa. And I'll be back tomorrow with another Tax Savings Minute.